information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities. I'm Mark Todd, FIIG Securities. If you have any questions, please pick up the phone and call us if you'd like to talk about the bond market or the equity market. 1300 30 34 35 and the email yourmoney@skynews.com.au. And joining me tonight on the panel is Tom Murphy, the Managing Director of Form, and Nick Bishop. He is the Senior Investment Manager at Aberdeen Asset Management. Welcome, gentlemen. How are you?
Very good, thank you.
Nice to see you, Mark. How's your week?
Sensational, thank you.
Really? What's happened with you?
Well, markets have been interesting.
Yeah.
We've had a few economic developments to chew over. Obviously, we've had a statement of monetary policy today from the RBA.
Yep.
Interesting developments overseas. So it's never dull in our markets.
It's supposed to be dull in the bond market. We're supposed to be quiet, sleepy old world. But Mr. Bernanke said, righto, in June we'll just wake everyone up. In June we get the sell-off. You know, he speaks to the Republican panel and he says, you know, we'll start to taper in the summer, or we'll start to do something and then move it out to September. What's your sense of it now in terms of the market's reaction to the Bernanke issues?
I think Bernanke let us know through his statement about tapering that it was time for the president to get ready to replace him, because January 31st is the final day of the term.
It comes quickly.
And it's the second term, and he's not staying on.
Yeah.
I haven't formally said that, but that is the case. And I think you've got Janet Yellen and Larry Summers now queued up to look at the job. There could be other people like Tim Geithner in line as well, but I think the main point was he was letting us know that. And he was also just testing the water to see what a statement about tapering would do to the markets. And he got a very clear answer. He
got a very clear answer, didn't he? That the volatility was so dramatic, and it was just, I'm considering. And I think, you know, we give a lot of credence to the investors, the traders, but we always needed to consider at some stage. So were you surprised by the vehemence of the way they moved it back?
I think the violence of markets was a bit surprising, but as well, I think it took a lot of investors by surprise that he was so candid in the timescale that attached the discussion of whether or not they'd be tapering. So not only was the idea, oh look, actually this is fairly close, you know, guys, and here's a timescale for you with a number of dates. And so that was genuinely surprising for markets, which had been lulled into this idea that, look, you know, low rates for a long period of time was the way to go.
I was thinking about that at the time. When everyone's selling, where do they put the money? I would ask all the guests that would come on and say, well, what do you think? But what did you think happened with those investments? Everyone just stayed in cash and just waited? Is that the idea?
It's interesting. If you look at some of the funds flow data, some of the asset classes that saw the heaviest outflows were what we call in markets carry asset classes. So in other words, investments where you can fund them with something that costs you very little and then you can earn some extra yield. So things like you know, high yield, maybe emerging debt, you know, emerging market debt. Some of those markets saw very, very heavy outflows, and yet money market funds saw inflows. So yeah, there was generally a return to cash as a safe haven.
People will take zero. What's your thoughts on the taper now? Is it a September taper? And has he seems to me to have done a great job in separating the idea of interest rates into the tapering. I mean, I think that's one of his credits. So what's the thoughts now in terms of the taper, and how do you think the market will react?
Mark, we've been of a view that the taper would start in the first quarter next year. But now it looks otherwise. It looks like we'll see the action in the next 2 to 3 months. And I think that's because in order to pave the way for a clear transition to the new Fed leadership, he needs to at least start that. So that terrible role is not given to somebody else who's just taken the job.
Oh, really? So you think he's trying to manage the Yellen, Summers, whoever it may be, into the seat where the volatility's come through the system? We've started buying 65 billion rather than 85 billion. You think that's you know, we've got the train has started to slow?
I do, because you got to remember 1987, because the Greenspan introduction occurred with the stock market crash. Well, the stock market crash occurred then. And the transition of Fed governors is a very sensitive time for equity markets, not only interest rate markets.
Really? Is that right?
So we have to make sure this is managed properly. And people that think the tapering is going to start in October, I don't know. October's bad luck.
Yeah.
There are two very bad events that happened in markets in October.
Yeah.
So probably September or November. It might seem like a strange way to time it, but no, I think October is the wrong month to guess.
And who's your take on the Fed governor? Who do you think will be the new Fed governor? Is it
someone that's on the same policy page as Bernanke, so that any kind of a policy shift is not picked up by the market.
Yeah.
The market needs to see a smooth transition, and both Yellen and Summers would give that.
Do you think that there's been some criticism, because I read the US press, in the way Obama's approached this? Do you think that's a warranted criticism? Do you think he's just been too slow?
The process is somewhat opaque, but it'd be hard to be otherwise, right? I mean,
yeah.
you can't pre-telegraph these things too much. I would say I slightly disagree with the prior point in the sense that in the way that Larry Summers and Janet Yellen would approach interaction with other members, voting and non-voting members, you would see some quite different modus operandi there. You know, Larry Summers in his time connected with the White House and in policy making, you know, is known as absolutely not a consensus builder. You know, he's a sort of his will be forced if he feels strongly enough. That might not gel with a more consensual type of operation. And Janet Yellen, I think, is, you know, in her time has proven to be a little bit more, you know, a bit more gentle, will perhaps try and do more work behind the scenes rather than be dictatorial. But I think Yellen is the more obvious sort of transplant for Bernanke in terms of that mindset being very similar.
What do you think?
Yellen is very close to Bernanke in policy approach. Summers is a little more aggressive, but they're both doves.
Yeah.
You can't call either one a hawk.
Yeah. Do you think that with Summers, though, there's going to be, and we are definitely going off the reservation here, do you think Summers will react to a lot of Republican negativity, you know, in terms of his speeches to the House and stuff that Bernanke has to do by his nature? Do you think there's a lot of Republicans who will be very aggressive to him anyway, so it'll be very tense scenarios with the Fed governor? Republicans
will be more aggressive toward Summers than toward Yellen.
Yeah. So it'll be interesting how...
Yellen's an easy call.
Yeah. It's a wonder if Obama will start to think of it that way in terms of what's the easiest call when he's a lame duck president, in terms of it's his last term, who does he leave and how does that play out? I think we've got time for a very quick email. So we have an email from Frank, and he has a question about the NAB pref. It's the NAB HA, and he says, have you any comments regarding the NAB prefs? NAB HA is the code. The returns look okay, but are there any clauses to be wary of? Thank you, Frank. Can I point to you about, not specifically, I can talk about that in a second, but specifically your reaction to pref shares in the hybrid world?
Sure, certainly. I think, you know, our view at Aberdeen has been quite consistent for a number of years in that investors really have to be aware of the risks in any given investment they're looking at. When you're thinking about pref shares or hybrids, it's very important to look beyond simply a headline yield number or a headline coupon number. You have to remember that you're very junior in the capital structure, so effectively you're equivalent to equity. You're only one level above equity, so if things go wrong, you're amongst the first in the firing line. Now that's all well and good. We don't have a problem with people taking equity-style risk. You need to make sure you're paid for equity-style risk. Now, a security such as NAB HA today, a yield of perhaps 6.2%. I think from memory NAB was 6.2% today. Now the gross dividend yield on NAB stock 8.5%. So there's over 2% differential there, and yet the risks are not dissimilar. And these are quite complex instruments for mum and dad investors. The documentation and the paperwork is very detailed, even for us.
And also the duration. What do you think?
I'm an owner of NAB HA.
We love them. I mean, I wanted to tell you that. As I'm saying that, I do love them.
And NAB HA trades at $71.
Yep.
And on the calculations we've done, because of the capital adequacy guidelines that make securities like these perpetuals less attractive to the banks to keep on issue, that security is likely, quite possibly, to be called by the bank early. 2016, 2017 would be the likely date. And that's because of what it does to the capital adequacy ratios for the National Australia Bank. Now, I only say that because if it's called, I would say when it's called at 100.
Yeah.
So your $71 security goes to 100 while you're paid the yield along the way.
Yeah.
So, and I take Nick's point loud and clear about it being close to equity on the risk spectrum. It is close to equity, but I like getting the yield where there's a very strong chance it's going to be called.
So the answer for Frank is there's two different scenarios you could play out, and it's a question of what your portfolio looks like and what you'd like to do. So, Frank, we've given you both different views, but we'll leave it there. We'll go for a very quick break. If you have any questions on the bond market or equities, give us a call, 1300 30 34 35, and the email yourmoney@skynews.com.au.
Connections. That's what life's about, really. You see that guy? He doesn't know it yet, but to export his coffee from Papua New Guinea to Asia, he needs to talk to that guy.
With business bankers wherever you're doing business, no one connects Australia and Asia Pacific like ANZ.
Connection made.
Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities. Joining me tonight is Tom Murphy, Managing Director of Form, and Nick Bishop, Senior Investment Manager at Aberdeen Asset Management. They're here to answer any of your questions, so feel free to pick up the phone. Call us 1300 30 34 35 and the email yourmoney@skynews.com.au. Can I chat about Aberdeen? What is Aberdeen? Who are Aberdeen? How big is Aberdeen? Just a broad thumbnail.
Sure.
Are they a nice bunch of guys to work
Of
for?
course, of course. We're guys and girls, obviously.
Guys and girls.
Sure. So Aberdeen is
quick later, Jane.
Yes, that's right. Quite right. She'd be disappointed if you didn't. So Aberdeen is a large independent global asset manager. We have assets of about 350 billion at the moment, split across fixed income, equities, property. Pretty broad. We're not owned by a bank or an insurance company, so we do have that independence. We've been around for over 20 years, and we're a FTSE 100 listed company, about £5 billion market cap. Now in Australia, we're not as big as the really big guys, but we certainly have a reasonable presence.
It's a massive size. You said 350 billion?
About 350 billion Aussie dollars in funds under management, yeah.
Wow. With huge amounts of numbers. It must be hard to be able to get your head around those numbers when you're trying to invest them.
I'm certainly not responsible for investing all of that, but yeah, look, it's you know, you have to have the business support and you know, the systems in a business that will support that level of
I just sort of mean, I think from the idea of crowding out, you know, if everyone wants to go long treasuries, you've got everyone trying to go long treasuries or getting views on different interest rates, momentums. It must be very hard to sort of, who's the guy outside of the cage saying, hang on, we're all going long interest rates, let's get somebody to take some overlay, because in the event that we might all, you know, London whale, that sort of stuff. So it must be a challenge to manage those sorts of businesses, which is a credit to the business. Yeah,
it depends on the market you're looking at. So obviously with a market as deep and liquid as the Treasury market, I mean, look at the size of some of those very big, you know, West Coast US bond funds, which are exceptionally big. You could say them. You know, but if you look at, say, you know, some of the smaller emerging equities markets, which can be quite niche markets and something Aberdeen is a specialist in, you do have to be careful there. There's a point at which you start to bump up against, you know, too big a size of a share register, for example. So yeah, it's a challenge. It's a challenge.
Tell me about Form. How's that all going?
Well, Form is an independent research group and advisory group for wealthy families and charitable foundations.
Yep.
So we manage a select few clients' money, and we manage in both the equity and the bond sphere. It's interesting that past 5 years, the appetite for income investments, such as those which Nick manages, is actually quite high, and that appetite hasn't gone away. And it's all about capital security and preservation.
And that's a trend that you've seen, and it's consistent. I feel that, you know, when we look at FIIG and the clients that are coming through, it's not a whim. They're not saying, oh, I wouldn't mind having a little dabble in fixed income. I'm buying fixed income for its benefits because that's just life. I need to have a consistent income.
Mark, that's right, because in 08, 09, when we saw such a shock to equity markets, a number of older investors could see that their superannuation fund falls, if they occurred at the wrong time, could actually make them vulnerable the rest of their lives.
Yeah.
So there's been a little bit of an asset allocation shift for the older clients. The younger clients will return to equities to the same degree as before, but the overall mix will be a little bit tilted away from equities for years to come.
Have you, I mean, we've had Mercer on every so often, and one of the things is their big theme is the post-retirement investments. And they think there's not enough work being done on that, and that's sort of consistent with what you're saying, isn't it? It's the retirement where you think, I've worked really hard and then I've got X amount of money, and then they don't really look after that money going forward. I mean, that's the challenge, trying to make that thing bang for your bucks.
Yeah, there's a big focus in you know, the common man's psyche about this accumulation phase in superannuation, or that investing is all about making as much money as possible. Whereas when you look at that post-retirement phase, what you're concerned about is longevity risk and preserving the real purchasing power of your income stream. So inflation is massively important at that stage.
Massive.
You know, shooting the lights out with your capital, you know, appreciation is not necessarily as important because you're in a drawdown phase. And you're right, we think there's an insufficient focus on that, and that's somewhere where fixed income still has a huge role to play.
Yeah, I think, I mean, without wanting to pat ourselves on the back, I think we're the only show that actually talks about inflation as much as we do. And I get emails, why do you keep talking about inflation? And it's like it's this bogey in the room, and you're saying that there's this really ugly guy over there, and he's looking to take 2.5% of your wealth every time he can put his hand in your pocket. You know, are you going to deal with him? Do you want to talk to him at all? And a lot of people just say, oh, well, I bought, you know, Wesfarmers. Okay, I don't quite get the correlation. You know, look after inflation via inflation. Tom, we've got guidance coming out from all the various governors across the curve, so the US, ECB, England. What's your thoughts in terms of the interest rate cycle? Where do you see interest rates starting to rise? Is it 2014, 2015? What's your thoughts on interest rates?
Well, interest rates in the United States are unlikely to increase at the short end, that is the official cash end, until late 2014 or early 2015. So the decision about tapering, this word that Bernanke has introduced, is going to precede the increase in interest rates probably by a little bit more than a year. And that's because all he's doing is reducing the rate at which he's buying securities.
Yeah.
But that will probably be one of the first economies to raise interest rates. The UK will probably follow, and Europe will be a year behind. So we're going to get a staged movement toward higher interest rates around the world, while countries like Australia have a completely opposite interest rate cycle.
Yeah.
And that's where it gets interesting.
That's really interesting. What's your thoughts? I mean, we seem to be going down at the same time that they may be going up, but I think interest rates, from the guidance perspective, is low for 2015 on average across the curve. I mean, have I got that wrong, or do you think the same?
No, not necessarily. I mean, if you look at market pricing today, and, you know, what do markets know, right? They've been wrong before. But markets themselves are implying about 18 months to go until the first rate movements in major markets like the US and UK, so bang in line with your thinking, Tom. Europe certainly later, more like 20 months plus. Now, for Australia, we certainly are at a different phase in the interest rate cycle, and this is where views diverge. Our market here locally is already pricing in more than one more rate cut within the next 12 months. Now, we can certainly have a debate about whether that is accurate or not, but, you know, clearly the economies are pointing in different directions at the moment.
So Tom, how do you advise clients in this sort of interest rate environment? We look to be going lower, whether we want to or not, whether the RBA wants. We don't know. We don't have that sort of guidance. We know that we're going to be accommodative. They are much lower. How do you advise clients in this low sort of environment? What's the theme?
I think the theme is that we don't try to pick the low in interest rates.
Yep.
We try to pick the direction. And I think that it's important just to advise clients that whether we get another interest rate cut this year or whether we finish out the year 2.5, we should focus the portfolio toward floating rate rather than fixed rate securities.
Yep.
We feel this very strongly because we believe that the correlation between bond yields here in Australia and bond yields in the US, whether Australia is on the same cycle or not, the correlation is a positive one. When US long rates rise, and if they rise sharply, Australian rates will rise as well at the long end, whatever happens at the cash end.
And that's what you mean by positive. There's positive effects,
Yes.
one up, one up. So
Yes.
we move in tandem.
The 10-year rates in both countries will move in tandem.
Yep.
And 1994 will give us an example of just how that happens.
Yep. What about you? In terms of those interest rate cycles and what you talk to customers about, what are you thinking?
Sure. I mean, our view for some time has been that we would see a cash rate that ends at around about the 2.5% level. So in our view, the RBA essentially is done, and whether that's a quarter here or there really makes pretty little difference. It's more about the future expectations in the market. And we think there are signs, some encouraging signs in the Aussie economy that we're set for a period of modestly higher yields going forward. Importantly, in this environment for investors, what you need to be thinking about are what we would call this idea of total return or absolute return strategies. So you can take advantage of features of the fixed income market without necessarily hanging your hat on this idea that you have to have yields going down as the only way to make money.
Yeah.
And I'll give you an example. So in say, our total return strategies, what we can do is take positions against bonds. So if we think bonds are going to rise, we can position accordingly so you'll progressively make more money the higher bond yields
So you
go.
sell futures as an example?
We can go short duration. It's a very technical term, but you can go outright short duration. Equally, with respect to credit exposure, if you think credit markets, non-government bond markets are going to do badly, we can actually position against that. We can short. So you make money in a symmetric sense in the market, not just with one direction.
We will be implementing our bond scores. We can talk duration soon, but we'll have to do that after another short break. Please feel free to give us a call, 1300 30 34 35, and the email yourmoney@skynews.com.au, and we'll be right back.
If you're thinking you can't do all the things you want until you knock down your credit card debt, you should be thinking ANZ. Transfer your non-ANZ credit or store card balances to an ANZ credit card and get 0% per annum for the first 9 months. Manage your money your way. Go to anz.com/balance transfer, call 13 33 33 or visit a branch.
In each decade of the past 30 years, the world has added another billion people. China and India have increased their wealth beyond anyone's expectations. Everywhere, money is on the move around the globe. Londoners are buying apartments in New York. Wealthy Chinese are buying properties in Sydney. Better connected, the world is a much smaller place if you're buying, selling or renting on worldproperty.com. It's person to person, place to place, locally, globally.
Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and tonight I'm joined by Tom Murphy, Managing Director of Form, and Nick Bishop, who is a Senior Investment Manager at Aberdeen Asset Management. They're here to answer any of your questions on 1300 30 34 35 and the email yourmoney@skynews.com.au. Before the break, we were talking about different strategies that you could implement, and I suppose that leads me to the question, the GFC meant that people didn't trust anyone. All the advisors just meant that, that people lost so much money they didn't trust their trusted advisor. It became a nondescript sort of title. That made it harder for people in your roles who are investors on behalf of other people to sort of get the return you need, get the money you need to do your job. How do you articulate that question, the value add? How do you talk about it? Because I think you're leading towards that when you're talking about strategy. So what does Aberdeen do as a value add that a self-managed super fund guy can't do, or girl?
Yeah, no, fair question. I mean, we think there's still, despite the very big development you've seen in self-managed super, there's still some really important reasons why institutional investors are relevant.
Yeah.
And
school fees.
Well, of course, I have hungry mouths to feed at home. But apart from that, the breadth of experience and the specialisation that our roles bring are very hard to replicate for an individual investor. We have a team of 14, for example, in our Australian fixed income team, 120 senior investors around the globe in fixed income, all with areas of specialisation. That's very hard to replicate as an individual. Scale brings with it some cost savings as well in some instances. It's not the be-all and end-all, but as a pretty big investor, we have 13 billion funds under management in Australia. That scale brings with it some ability to leverage our relationships with with service providers. And equally, we can get access to policymakers, for example, that you just can't get as an individual. So, you know, access to Glenn Stevens, to Guy Debelle, to those senior policymakers is available to us. It's not necessarily for a retail investor.
But there's also, Tom, I mean, I know with your business, they're knocking on the door, and you're saying, hang on, there's only a certain amount I can take and carry on. So there's a value add that they, you know, people know that you provide. I would guess it's also access to different product. It's not, you're across a whole range of different product that maybe the self-managed super fund isn't aware of, but you're also, that experience sort of, it's hard to replicate. My sense is that people retire at 60. I've had the self-managed super fund for the last 2 or 3 years, and now I'm an investor. And that's hard because I used to be a plumber. So what's the value add that when you talk to your clients, how do you articulate that?
Well, Mark, I'd pick up on Nick's comment too on this, because a self-guided superannuation fund individual who's got the responsibility of managing his family's superannuation typically approaches the income assets through managed funds, because the level of diversification you get through a managed fund is essential for that investor. And if that investor has a fund of a couple of $1 million and he's allocated 40% to the fixed interest arena, he really doesn't have the scale to be doing the fixed interest directly. So even though that investor probably owns bank shares and Santos, Woodside, and all the rest directly, on the income side he doesn't touch it. He's terrified of it. Yeah. It's way too complex. I spent half my career managing equities and half managing bonds, and I'll tell you right now, there's a lot more skill in managing bonds than equities. It's much more complex. So those investors don't want to go near that. And there's a lot more in the financial media about equities. They're easier to understand. They're easier to get information on.
You know, I would put it more down to that. I do feel that the bias in the media becomes so obvious. You sit down and you look at it. You know, you always keep going back to the equity. This is whereas. I hear what you're saying. You can be as complex as you like, but in the bond market, you can also be as simple as you like. Do I buy government bonds? You know, inflation-linked bonds. You know, and when you start talking to the capital structure, I mean, I think the theme that we have at FIIG is trying to talk about the education first, and then the asset sells itself. Here's an asset that will give you a 6% return. It's Qantas, it's Leighton's, it's whomever, and you feel a little bit more comfortable once you understand how capital structures work and where the payout works, and then because I feel the equities. So much of the decision is made around a cup of coffee. You see a friend in a coffee shop and he says, go and buy Newcrest because it looks like it's really good because I think gold's going up. And how often does that work? That becomes quite challenging. We want to implement our first bond school. We had a great email from a podcast listener who said one of the things is what we're talking about. Equities, everyone knows equities, they know how to trade them, don't know anything about bonds. So, Nick, as the educator that we would like to bring into the game, you're going to talk about a thing called duration. So if we could bring up the chart that Nick would like to talk about, and bond school number 1 starts today. So, Nick, let's talk about duration. What is it, and how does it affect people?
Sure, absolutely. So the chart looks a little bit complicated, but let me explain. Bear with me. As most of your viewers will know, there is an inverse relationship between price and yield with bonds. So in other words, the yield that you invest in a bond, if that goes up, the price of your bond goes down, and vice versa. Now, we can think about duration then in terms of this little seesaw here, or a lever. You've got a fulcrum point in the middle there. If I push down on one end of the lever, the yield end, the other end of the lever goes up. That's the price rising. Now, duration is describing how far out on that other bit of the seesaw I'm positioned. Am I right at the far end of the seesaw? That means a very small push down on the yield bit means a big, big rise in price. Or am I right close to that fulcrum point there where cash sits, where you can move the yield up and down as much as you like, but the price of that, the value of that cash actually doesn't really change. $10 in the bank is still $10 in the bank. So that's what duration is really describing. It's sliding up and down that seesaw. How sensitive am I to movements in yield?
And so Tom, when we talk to people who say they're going to shorten their duration, we're getting closer to the middle. So they do that by selling futures, or what way do you shorten duration?
Well, you shorten duration because you're not sure about the direction of interest rates and whether interest rates might rise. And an investor who has a fear that interest rates are going to rise, long-term interest rates that is, will opt for floating rate instruments which have virtually no duration.
Yep, right. I think one of the things that we wanted to sort of expand on is around this idea that, you know, we feel at FIIG it's all about education. That's really the key to it. If you get a lot more education, if you're more comfortable about your assets, and it's about setting your portfolio in the right settings to what your risks are. But let's talk about MySuper. MySuper is, what were you telling me, Nick? It's 80% goes into the default?
Around 80% of superannuation members will never exercise any discretion away from the default setting. Yeah.
So the argument about, you know, whether you have education or you go to Tom is irrelevant if we're just hitting default. So my sense is that MySuper is just a low-cost alternative. And as a consequence of being a low-cost alternative, you have a low option investment pool. Is that the right way to look at it?
Yes and no. I think, to be fair, what the government is trying to do with MySuper is very much simplify the world of investments, very much like you're doing with the education angle from FIIG, and that is laudable. I think it's trying to reduce fees, which doesn't necessarily mean better value for money. That's one of the downsides. Simplicity should go up, ease of understanding should go up, but there are some potentially adverse consequences. One interesting point is that to produce a product where the fee is capped that the manager can charge, you have to try and reduce some costs elsewhere to keep your profitability of your business going. One way to do that is to supply funds into MySuper accounts that are tracker funds, ETFs or just index tracker funds, not actively managed funds, because they're cheaper. But is that a better deal for investors? Not necessarily. We know there's some big perils with just being index oriented.
We are going to talk to you about what you think of tracker funds. I haven't prepared you for that one, so I'm going to go to a very quick break, and we'll come back after this break and you can tell me what you think of those tracking funds. So we'll have another short break. Please give us a call on 1300 30 34 35 or the email, as you know, yourmoney@skynews.com.au. We'll be right back.
Dennis is the leader of an interplanetary army.
Gotcha.
And at AGL, we think it'd be a shame to have to sacrifice his destiny just to save money on energy. That's why we have so many little ways to help him use energy smarter. Like new My AGL IQ. So he can still save without having to stop doing all the things he loves.
And the world is made of energy. I don't care. I love it. I don't care. I love it. I love it. I don't care. I love it. I don't care. I love it. I love it. I don't care.
I built your man cave.
I'm smelling your new car smell.
I've got your rock.
Got your jet ski?
I'm enjoying your retirement. Shh.
I'm riding your daughter's pony.
The major banks and their low-interest accounts are stealing your dreams. Steal them back with a high-interest savings account from RiboDirect. Visit ribodirect.com.au now.
Life is a journey in which we're all travelers. Looking to make that great trip with someone. Journeys are made by the people you travel with.
The debate is this Sunday night, and the best post-game analysis will be on Paul Murray Live. We'll tell you who won, who lost, the good bits, the bad bits, and the bit everyone wants to forget. See you Sunday, only on Sky News.
Holden, proudly sponsoring Paul Murray Live.
Welcome back to the show. Tonight I'm joined by Tom Murphy, the Managing Director of Form, and Nick Bishop, Senior Investment Manager at Aberdeen Asset Management. If you have any questions on bond or equities, please feel free to pick up the phone 1300 30 34 35 and the email yourmoney@skynews.com.au. Before the break, Nick was chatting about the MySuper option, and as I was saying in the break, I didn't realise how many people are in it. What's your thoughts on MySuper?
Well, I don't know how many people are in it yet because it's still a relatively small and new product, but it's an interesting one. And just about a month ago, I was helping somebody who's close to me out with her superannuation program, and we're talking about $200,000 to $300,000. and it was a rollover amount. And I like my super. And I like the structure because of its low cost, especially for investors that are under that threshold, which I would say is $300,000 for a self-managed fund. And the My Super structure delivers that. But the thing I found really interesting, Mark, is that when I went onto the net to learn about My Super, and the product I was looking for was the Westpac product, which is a very good one, I had
not sponsored by Westpac, by the way.
No, I had a great deal of difficulty finding information on it. It is not being promoted.
Really?
And it's not being promoted, I believe, because it's not that profitable to the issuing institution.
Is that right?
If you go onto Westpac or Colonial, which I also looked at, or ANZ, it's hard to find the links for My Super, but you're immediately directed to the professionally managed funds. And it's all well and good that both are available, but the My Super one is so obscure and so hard to find that it worries me a bit because it's a fantastic product, but not a highly profitable one for my industry.
Yeah, right. So I guess, you know, the education is the key to all that sort of stuff, and I understand that, and that's a really good point. I didn't know that was happening. How do you, at Form, manage the information and the education? How do you do that? Do you have to do that with your clients? Are they sophisticated enough and they know what they want, or how does that work?
Well, they're at the very high net worth end of the spectrum, because that's all we do, or they're charitable foundations. So products like My Super we don't deal in. But the kind of clients we deal with deal in wholesale managed funds like NICs, and Aberdeen products are on our suite products. But the focus we have is in getting wholesale products of a true wholesale nature, low cost that is, that are high conviction in their structure. In other words, not trying to hold every stock, but really taking a position.
What do you do, for both of you, I think it's an open-ended question, how do you get the information you feel you need to be able to be professionally engaged? You know, we are swamped 24/7. I did a presentation and I gave them one day's information from 4 news sources, and it was just, and I made it as a scatter. It was because I couldn't keep it on one presentation. It's just pumping to people. How do you filter? What do you do? How do you?
No, that's a good question. I mean, Aberdeen's process, and this is very clear across equities, property or fixed income, is very much fundamental research-based, proprietary research-based as well, rather than paying any third-party vendors to provide that for us. Now, that's quite labour-intensive. That doesn't come very easily. That's why we've got, like I said, over 120 senior fixed income investors and an awful lot of equity investors. So conducting our own research means you need to hire the right staff. You need to have good systems to be able to filter that information. We research all of the investments we do. We write regular research notes on all of the investments we either have exposure to or could potentially have exposure to. And that's an ongoing process. It doesn't stop. We're heading into quarterly reporting season now. That is a very busy time for all the analysts at work, and there's long hours involved, but you have to do the research, and you have to do that yourself. You have to know the dynamics that are going to affect the value of your investment. So there's no substitute for that.
What about yourself?
We take a different approach to most people because we have a very tight client list, and it's at the high net worth end of the spectrum. So we probably only have 45 approved funds on the list.
All right.
So the monitoring of those funds is easier because it is only those high conviction products that our clients are interested in. They're willing to pay the fees. In fact, they're willing to pay the performance fees. And that's the difference between my client base and the average client base. The average client base is so fee conscious, the My Super end of the spectrum, that you can't even talk about performance fees because they don't fit the model for the reasons Nick mentioned. But at the other end of the spectrum, people will happily pay performance fees if the performance is very good.
So there's an element in me that says that those who don't pay the performance fees, you know, never get to the point where they become your client because they're never really getting the same sort of return. So there's that fine line where you've got to drill down intellectually and get engaged. You can get a better performance out of your fund rather than just assuming that you'll track something.
Yeah, I mean, there is that. One point I'd make there is that Australia particularly, and rightly because there is a compulsory super contribution process, Australia rightly has a lot of gatekeepers in place which seek to sort of protect notionally investors, but that means that the fee pressure is absolutely relentless. Our overseas colleagues are very surprised when they come to Australia, which despite being a very big market in terms of funds under management on a global scale even, has got exceptionally low fees. The pressure is fairly relentless there. So, you know, we can understand that, we appreciate that, but there is some trade-off between price and value for money, the services that can be provided.
Is that the same? Why is that? Why do you think is it driven by the gatekeepers? Is it they get some benefit out of being able to cut the fees? Do they get something out of it? Like, how does that work? I mean, is it the politicians that are saying, okay, I'm trying to win votes by saying they earn too much money? And clearly some of them really earn too much money. I get all that, but you got to see some value in buying some service, don't you? I mean, what do lawyers do?
Yeah, I mean, look, I'm going to sound like I'm talking my own book. But
you can talk about it. You know, you've got a smaller business and your clients happily pay fees. Lawyers, I mean, shouldn't there be a point in time where we tip and say, okay, I need to actually pay some money to get the right advice. I just need to know what the right advice is. Isn't that the key to it?
Yes, it is. And admittedly, if you have a very large portfolio, you can get super high-quality advice for 0.1% of assets under management.
Yeah, right.
Now, in the middle market, to go to a private banker, maybe a private banker that's owned by one of the international firms, costs you 1% of funds under management for that layer of advice. So it's really expensive.
You better be right.
The ultra-high net worths have a better deal because of their scale. They are truly institutional investors.
Right. We have to go for another very quick break. We'll be right back. Please feel free to give us a call on 1300 30 34 35 or the email yourmoney@skynews.com.au.
With CFDs, I can trade on the rise and fall of indices, shares, forex and commodities.
It's important I can pursue 24-hour trading opportunities and still control my risk.
I use CFDs when I want to trade the markets without putting up the full value of my position.
That's why I trade CFDs with IG, the global CFD specialist, creating opportunity since 1974.
Dennis is the leader of an interplanetary army.
Gotcha.
And at AGL, we think it'd be a shame to have to sacrifice his destiny just to save money on energy. That's why we have so many little ways to help him use energy smarter. Like new My AGL IQ. So he can still save without having to stop doing all the things he loves.
And the world is made of energy.
Welcome back to Bonds versus Equities, the edition of Your Money, Your Call. And to some extent, it's bonds and equities now, isn't it? Joining me tonight on the panel is Tom Murphy, Managing Director of Form, and Nick Bishop, who is a Senior Investment Manager at Aberdeen Asset Management. We're here to take any phone calls if you feel free to call on Your Money. The email is yourmoney@skynews.com.au. Now let's talk about, we've got a viewer's email. We've got Ruben came through, and Ruben, he says, hi, our current household income is $260,000 per year. We're trying to save for our first home. We both put the max per year into our super to save for the future and take advantage of the lower tax. We currently have $200K in cash in a high interest saving account. With interest rates as low as they are, and they are now expecting to go lower, how would you suggest we invest over the relative short term, 1 to 3 years? Regards, Ruben. Tom, what would you say?
Well, first of all, I commend Ruben on the decision to keep the money that's going to be used for the family home in cash.
Yeah.
A number of people like Ruben have done the opposite. They've invested the money that's going to go for the down payment of the family home in equities.
Right.
A very, very dangerous position to be in.
Yeah.
So he's on the right track there. The other thing I'll say is that Ruben's balance in cash is under $250,000. And I say that because in Australia, approved deposit institutions, ADIs, are guaranteed by the government up to $250,000.
Yeah.
And it would be just interesting just to say to the listeners that they could go to the APRA website and they would mostly be surprised to see the number of ADIs that are out there. It is 3 pages of building societies and institutions, 90% of which I've never heard of, and I've been in the game a long time. And these institutions are guaranteed up to $250,000. So if Ruben had $550,000 in cash, I'd tell him he needs to go to 3 institutions to spread that risk. It's very important.
Yeah, you know, Police Bank, the Teachers Credit Union, all these guys, they're billion-dollar balance sheets, and they get the government support, and you know, the fifth pillar is what the government needs, because the full banks are so dominant. So clearly, it makes sense to support it. So it's just a question of what rate they pay for the term deposit, but that should be fine. Great answer. Let's talk a little bit. We're going to shift gears. I want to talk about the United States. As an expert in the United States, how do you see it performing over the next 6 months? What's your thoughts in terms of both the politics, because we're starting to talk about debt ceilings and all that sort of stuff, and the economics? How does that look to you, going into the end of the year?
The United States economy has improved by so much that it's now pulling capital away from the emerging markets because of the growth turnaround. And the growth turnaround is being evidenced by talk of tapering of quantitative easing. And that talk of tapering can only occur if we're at the point where growth is actually picking up. It's not impossible that in the year 2014 we will have at least one calendar quarter where growth exceeds 3%, which is roughly the trend growth rate in the United States, the non-inflationary growth rate. But at the moment they're not growing at that level, but they're growing at a fast enough rate that if you look out to 2016, the debt-to-GDP profile of the American economy is heading toward the normal level. And only a couple years ago, there were commentators talking about America's debt being as bad as Greece's. It was never true, but they were saying it.
They certainly were. They certainly created a real fear, didn't they, about it, where our debt was going. It became, and it's the same here. You know, Cameron Klein, the NAB, was right. We have a serious debt problem. We don't have enough of it. We don't have an adult conversation about it. And he was the only one in the political cycle that made any sense. You must want to be a politician. What's your thoughts on the US for the next 6 months?
Yeah, sure. I mean, broadly speaking, would agree with Tom. I mean, we're pretty constructive on the US, and we would essentially agree with the Fed's forecast for growth profile. I mean, what the Fed has said is that they will they'll follow a fairly prescriptive path of unwinding quantitative easing should certain hurdles be met in terms of economic metrics. Obviously, unemployment is one. There's this idea of 6.5%, but that could be moved. Being comfortable with inflation is another. But we think there are enough signs there that growth should perform reasonably well. Not like the old days, but this is not the old days, but reasonably well. Now, importantly for Australia, and you mentioned this before, Tom, that has a big role to play in what happens with Australian yields. You know, the long end of the Australian market is tethered with an elastic band, but it is tethered somewhat to US yields. And so one reason why we feel yields will be, somewhat higher in 12 months' time is because of that constructive US outlook.
Well, let's talk about the Aussie. What do you think of the Australian economy? How will it perform over the next 6 months if the US are moving up to, a more robust period, sequester or not, politics or not? How does the Australia look?
Well, this is a gift because as the US economy improves, its trading partners improve because of the scale of its economy. So Australia, even with the worst policymakers and a mining industry that's falling apart, will still grow at 2 to 2.4% next year.
And that was no political statement from Tom, I can assure you. He thinks all of them are hopeless.
And honestly, we're really lucky because, yes, we are an importer of capital, and yes, when interest rates in the United States rise at the long end, we rise too because we're an importer of capital. But take that off the table for a second, just look at economic growth. If the United States were in the doldrums it was in 2 years ago, and we had the mining boom coming to an end, as we just have, we would have negative GDP here. And we're not going to.
We're not.
The next 3 years, there's very, very little chance we will have a recession here.
Your interpretation of the Australian economy?
Yeah, look, I mean, broadly speaking...
Without the political statements of my fellow American
I'm English, what would I know about Australian politics? No, look, I mean, we'd broadly agree with that. We see some nascent signs of encouraging growth in Australia. Monetary conditions have eased significantly, especially with the recent fall in the currency. We think that's important. Household balance sheets look better, certainly from a cash flow perspective, because so many borrowers in Australia have floating rate mortgages. That's quite a powerful dynamic to have, and that does contrast greatly with a country like the US. So, look, it's early days, and the market is pricing more than one interest rate cut from the RBA from here even. It's between 1 and 2, and we're not that pessimistic. We think, we think there are enough reasons to think that yields will rise from this point, and Aussie growth is not a disaster.
Do we get a housing bubble? I mean, the mortgage rates are incredibly low, low fours. We've got people ringing up saying, okay, what corporate debt can I buy because I'm going to borrow as money from my home, and I'm going to buy corporate debt because I've just got to work out what other asset I want to buy, but at the moment I want to take advantage of it because it just doesn't seem right. I mean, 4.5% mortgages just doesn't seem to make a lot of sense. Can you imagine a housing bubble taking place over the next 12 months?
Look, I mean, I think if you look at the level of housing approvals, if you look at the level of borrowing that's going into housing, we're a very distant point from some of those bubbly periods, more, say 04, 05, some of those periods, or even as recently as 2010. So, some of those characteristics are not that worrying. CBA were commenting today on just this fact that certainly CBA, which is the biggest domestic lender for mortgages, does not see a housing bubble as any kind of high probability. Never say never, but I think that investors and homeowners are still really quite cautious that you would expect a response from housing with interest rates as low as they are. It would be weird if there wasn't. Yeah. You're the same. Look, we're going to have it. Well, we'll talk about your housing view in a second because it's time for another short break. The day is rapidly going out. We'll be right back in just a moment.
If you're thinking you can't do all the things you want until you knock down your credit card debt, you should be thinking ANZ. Transfer your non-ANZ credit or store card balances to an ANZ credit card and get 0% per annum for the first 9 months. Manage your money your way. Go to anz.com/balance transfer, call 1333 33 or visit a branch.
Save on car insurance with Coles Redwood. Insure your car with Coles Comprehensive Insurance, and you can rely on Coles Insurance's national partnered repair network, whose repairs all come with a lifetime guarantee.
And so I say
that Coles little quote.
It's a great little quote.
It's my little quote.
Save on car insurance with Coles Redwood.
So call or visit Coles Insurance and save with Coles Redwood.
Welcome back to the last segment for the night. Joining me on the panel is Tom Murphy, the Managing Director of Form, and Nick Bishop, a Senior Investment Manager at Aberdeen Asset Management, here to answer any questions if anyone felt to call. But let's just talk about the currency. It's so important. I remember when the RBA was cutting rates and they were saying, I want people to move into the mining sector, I want mobility in the workforce. The US is a highly mobile workforce, and I think they thought now with the currency coming down, you'll have other segments of the workforce improving the balance sheets. How important is the currency, and where do you see it going in the next 6 months with the US? What happens to that correlation, US-Aussie currency? What's the Aberdeen view on that?
Yeah, no, good question. I think first point we'd make is that in Australian context, there's a lot of focus on the Aussie dollar versus the US dollar. Yep. But actually much more important to think about is the trade-weighted basket for Australia. Our biggest trading partners are all on our doorstep: China, Japan, Korea. Those nations are actually what's important for Australian growth. So we focus on the trade-weighted index rather than Aussie-US dollar, but that's a minor point. The RBA clearly would like the currency lower. It's important as a growth stimulant. The sectors you mentioned, overseas education, tourism, manufacturing, will all benefit at the margin from a lower currency. How much lower? Look, in our view, somewhere between 85 and 90 cents is reasonably fair value. You can look at traditional measures like purchasing power parity, but look, essentially that sort of range we think would be fair, but that's not a forecast, of course.
Clearly not. We never make a forecast on television. What do you think, mate, in terms of the currency?
The $8 has high buying power even today, given the sell-off we've seen. And the reason it has a lot of buying power is that we've had a significant inflow from foreign central banks who are looking to own our bonds to diversify their holdings. Yeah. It was only 10 years ago that many international international central banks only held euro, yen, US dollar, and sterling balances. They now hold Brazilian, Russian, all kinds of balances, especially currencies outside of the ones they already held. And when the euro came together and took away such currency diversification and combined 17 currencies into one, it left central banks looking around the world for currencies to diversify.
And now they separate it, don't they? They separate the Canadian and the Aussie as part of the IMF's investments. They separate those currencies because they're now relevant, aren't they?
Yes, they do.
I just suppose we'll be very, very quick. It just seems to me that Bernanke said rates are low, and people are now going to move out of the US dollars because why would you be in the dollars? And so I think it's just going to put pressure on the currency, our currency to go up.
Well, yes and no. I mean, what's happened in the US is that the economy has improved, and you can, in a way, you can think of a currency as the equity of a country.
Yep.
Okay, so the better the growth prospects for that country, sometimes the more inflationary, but not necessarily, but essentially growth and stable policy are usually strong for currencies. So yes, interest rates have been low in the US, but because prospects are turning around, and that's why they're looking to wind back QE, that actually has been very positive for the dollar.
Last couple of weeks, that US has been troublesome. Don't you think in terms of the dollar yen, that's been creating the strength in the US dollar has been a problem for some of the global economies?
Yes, it has. And let's remember that over the past few years, Bernanke's words have been words to devalue the U.S. dollar because they're trying to create inflation.
Yeah.
We don't want inflation in the emerging markets, but we need inflation in the United States. And the Fed is still on the side of the devalued U.S. dollar, not a stronger one.
Because the inflation in the States is very benign, isn't it? I get the feeling, and this is a theme that I've had, they've had no wages growth. Once they have a jobs recovery, I do feel that people are going to put their hand out and say, I'd like a pay rise. And they haven't had a pay rise since 2007. So let's say it happens in 2014, you'll start to see a real spike in that inflationary piece.
Yeah, I think the problem is that you have a swathe of the American population that's almost structurally unemployable now. So what tends to happen is you get, employers are very reluctant to hire people who've been out of work for 6 months or more. There's a real cliff effect in terms of how easy it is for those folks to get jobs. So you've got, you have a pool of labour there that if the economy did ever really accelerate, you've got some very cheap labour there that would be ready to re-engage with the workforce. They're not even in the workforce statistics today.
Yeah, that's right. But the big growth has been in the services sector, hasn't it? It's been on the very manual jobs.
Yes,
so
it has.
those people might be coming into the economy now, maybe. But it's very noticeable. There's not been the academic. It's not been the white collar. It's been definitely that service-orientated business. Look, that's all we have time for today. Thank you so much, guys, for coming on the show. I'd like Tom Murphy to thank you for coming on. Nick Bishop for you coming on. It's been great. I've really enjoyed it. I hope all the viewers have enjoyed it. And there's been 2 emails, so thank you for that. No calls. Well, thank you for that. Must be a great Friday night show on. Until next time, I'm Mark Todd from FIIG Securities. Have a great night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.